Hello, everybody, and welcome to the National Center for Employee Ownership's presentation today. My name is Timothy Garbinski. I am the Communications Director here at the Nceo, and today's presentation is about, is an ESOP right for you? We'll get started in just a moment. We're going to let people sort of digitally file into the webinar room, so give it just a moment. That can take a minute or two, and then we'll be well on our way. In the meanwhile, while people are filing into the room, let me go ahead and start and tell you a little bit about how this will work. This webinar will have two presenters who I'll be delighted to introduce you to in just a moment. While you are watching this presentation, though, we would warmly encourage you to ask any questions that you may have. This is a Zoom webinar, and Zoom has a Q&A function you'll see on the sort of Zoom bar on your screen. Please use that to ask any questions you have. We will ask those questions at an appropriate point during the webinar. There's a Q&A section a little bit later on. If you are using the Q&A function and you see somebody else has already asked a question that you too would like to see answered, there is a little thumbs up button next to some of the questions. So please use that to indicate which questions you would also like to see answered. That will sort of boost it to the top, and we will answer them in that order. Otherwise, please also feel free to use the chat function. You can communicate with all of us panelists that way. And see, we already have our very first question. Fantastic. Feel free to take notes, absolutely, but we can and will provide slides and afterwards the recording as well. So also feel free to just be engaged visually with the presentation on those terms. Fantastic. So without further ado, again, thank you so much for being here with us. My name is Timothy Garbinski. This is the National Center for Employee Ownership's presentation of Is an ESOP Right for You? As I already mentioned, there will be follow-up after this as well. So you will get the recording. There will be some connections to our presenters afterwards, as well as to our sponsors. So you can get any questions answered that are not dealt with during this presentation. And now that I've mentioned our sponsors, before we get started, I do want to thank our sponsors, of course. Our sponsors for today's presentation are Atlas Legal Services, Butcher Joseph & Co., Butterfield Schechter LLP, Menke, and South Park Advisors. We'd again like to thank all of them for their support today and ongoing throughout the years of the National Center for Employee Ownership. With that said, I will now turn it over to the NCEO's Executive Director, Lauren Rogers, who's going to talk a little bit about what exactly an ESOP is. So without more, go ahead, Lauren.
Sorry about that. I was just unmuted there. So Tim, thank you so much for that introduction and welcome everybody. Delighted to have you here. And I'm delighted to be speaking today with Ashleigh. I think this is going to be a great presentation. Let me tell you a little bit about why we're here. It's because after you, someone is going to own your business. The only alternative future is where your business goes out of business when you leave it. So you'll need to make some decisions either by default or consciously in planning for who that someone is going to be. That's what this webinar is about. We want to help you be sure that you are happy with the choices that you make now, so that whoever that someone is someone that you'll feel good about when you're telling this chapter of your life story to your grandkids or whoever you're talking about. What happened to this business that's so important to you right now? So who are we as the NCEO? We're here because our mission is to make employee ownership thrive. We're a 501c3. We're a nonprofit organization. We're not here to make a transaction happen. We won't help you make a transaction. We don't know how to do that, and we intentionally don't do that. We don't lobby. Our role is simply to be a resource for you to help you make sure you're making the choice that you are going to feel good about. in the long term. So we do that in a bunch of ways. We do that with webinars like this. We do this with research that's kind of at the intersection of academic quality and applicability to how people make decisions in business. We do it through education. We have 30,000 person hours of education in a typical year. We do it with publications. We have over 70 titles, and we do it over 40 years now. We're just celebrating our 40th year and entering our 41st. And we have well over 2,000 members, almost 3,000, and that's what we're here for. But to answer this question on the screen, how can you be sure you'll be happy with the research, with your choice? Decision-making psychologists have a clear answer to that. The best way to be sure that your future self will be happy with the choice you're making now is to talk to somebody who is in a situation like you are currently in. And in this case, Ashleigh Walters is going to be speaking, and you are in the place where she was 3 years ago. So she'll be able to give you a great perspective, not only about what motivated her decision, but what choices she and her husband Drew faced, and how they came to this, and how an ESOP is looking at this point. All right, so that's what the purpose of this webinar is. Let me tell you just a few things, sort of core facts about ESOPs, because one of the things we've found is that people develop an interest in the idea or lose an interest in the idea because they have some basic facts wrong. So first, an ESOP is an employee stock ownership plan. It's one way for a company to be employee owned in the United States. It's not the only way, but it is the most common form of employee ownership in the United States. Below that on the slide, we've got a one-sentence summary of how an ESOP transaction works, which is that you as the owner sell your shares at fair market value. The entity that buys those shares is a trust. It's not the employees as individuals. It's a trust which will be the owner of your shares. And the trust is legally required by federal law to operate for the exclusive benefit of the participants in that trust, your company's employees. So there are two features of an ESOP that come out of the way it was designed. The first is that when Congress was figuring out how to create ESOPs, when they're in the original debates back in the 70s, they wanted ESOPs to be a way to own company shares. They wanted an ESOP to be an entity that could own a company on behalf of employees. So an ESOP is an ownership vehicle. The second piece is that because of the sausage making in Congress in 1973, ESOPs are governed under retirement plan law. They are subject to a lot of the same laws and regulations and oversight as your 401k plan is. Now, that's got a lot of advantages, and it also imposes a lot of rules and some complexity that you need to understand as you put an ESOP into place. So the next thing, a basic fact about ESOPs that you should understand is where they are and how many of them there are. There are just shy of 6,000 private companies that have ESOPs. There are also some publicly traded ones that do. In those private companies, there are over 2 million people that participate in those ESOPs. And those 2 million people have well over $100 billion in company shares. That's an asset that most of those people would certainly not have if it wasn't for the ESOP. And what these numbers mean is that the performance of ESOPs can be demonstrated in a lot of ways. Since ESOPs were put in place in the 70s under federal law, we've got a lot of decades of data, and a lot of people have done research on how ESOPs work. We at the Nceo are proud to be one of the organizations that have done that work, but there are academics, the Government Accounting Office, and all sorts of organizations have studied ESOPs. So on the next slide, you'll see some of the highlights. I tried to consolidate several decades worth of research into a single slide, but the short version is that ESOPs grow faster. They generate more new jobs than they would have generated if the same company did not have an ESOP. Their sales grow faster, they're more productive. ESOPs are also more stable. They have ridiculously low default rates compared to companies that take out comparable loans for comparable M&A transactions. They also have far lower risk of failure, meaning that ESOP companies are far less likely to go bankrupt or be acquired than comparable non-ESOP companies. And that's true in the midst of our last two recessions. So when companies are getting sorely tested. And then third, employee-owned companies generate more wealth. There's a great study at ownershipeconomy.org that shows that if you look at a nationally representative sample of just millennials, they have 92% greater net household wealth if they're employee owners than if they're not employee owners. And that's a trend that applies throughout all the demographic groups we can study. It's true for single mothers, for people with college educations, without high school educations. It's people for all demographic groups. It's all over. So those are some facts about ESOPs. And the last thing I'm going to do before turning this over to Ashleigh is to mention a couple things about misconceptions and common things you need to know about an ESOP before you start digging into it. The first question is, how much will an ESOP pay you for your shares? An ESOP is going to pay fair market value. That fair market value is going to be determined by an independent appraiser. Now, you might be able to get a higher price than fair market value. There may be some people in private equity or a public company or a holding company that would pay strategic value, and that may be higher in dollar terms. You may even end up with a higher take-home value from a strategic buyer, but don't assume that's the case until you've done some of the math, because ESOPs do have some pretty substantial tax benefits. And those tax benefits can make up the difference between a strategic price and a financial fair market value price. You may not also have the option of getting strategic price, but that's how much you'll get. An ESOP can't pay more than fair market value. A second question is about whether employees pay for their shares. This is one of the most common questions we get, and when we speak with interviewers, they keep coming back to this. No, employees do not pay for their shares. Now, I've talked with a lot of lawyers and they want me to be careful. It is possible to set up an ESOP transactions where the employees sort of pay for their shares by transferring some money out of a 401k plan. But in the vast majority of cases, the company makes a contribution to the ESOP. And that contribution, like a 401k contribution, is a benefit for employees, but it also has the impact of buying shares over time from the owners. The next question that we often get is whether you have to sell 100% of your shares. You don't. You can sell 100% of your shares, and the most common ESOP transaction these days is for 100% of the shares, but you can sell any portion of your shares. Another thing to note is that the ownership and the management transitions can be on different tracks. You can sell all of your shares in a single transaction and stay on as a CEO or a board member. You can transition out of a CEO and board member, but continue selling shares for many years after that. There's a lot of flexibility with an ESOP transaction that you wouldn't have by selling to a third party. All right, so those are some of the common questions we've got. Now let me have the pleasure of introducing Ashleigh Walters, the president of Onex, and she's going to talk to us about how this looked from her perspective and what kinds of decisions they made. Ashleigh?
Thanks so much, Lauren. It's a pleasure to be here today. Tim, could you advance the slide, please?
I mean, I actually look forward to coming to work in the morning. It's been a long time since I felt that way about a job.
Just within the last 5 to 6 years, a total transformation from how Onex previously operated.
The meeting was derived a couple years ago with some of us from management saying, how can we bring the group together, make everyone part of a team?
I think it's helped us a lot with communicating and getting things organized.
Everybody knows what to expect for the day, what needs done today.
Everybody has an opportunity to make things better and provide input.
You have your chance to speak up if you want to speak up. Anything that bugs you or whatnot, you have Friday meeting to say it, and then we'll fix it.
We know what needs to be worked on, how we've been doing, and how we can improve.
The environment here is great. I've worked for a big company, and being there was 18,000 employees, where here we have a small, tight-knit group, and everyone's kind of like a family.
It's just a really busy place. Everybody's doing their own thing. Everybody knows what needs to be done, and they just get it done.
Everybody gets along between management and the floor. It's a good place to be.
You can tell someone cares. You're not just a number anymore. You can tell that they really, truly are vested in you and are worried about your best interest as well as their own.
Everybody knows your name. It's like a family. It's a family environment.
They've been wonderful. They really take care of us, and they make all of our opinions matter.
We're all basically given a path of the sky's the limit.
I've been with Onex for 5 years.
I've been here 6 years.
In August, I'll be here 2 years.
I've been with Onex for 14 years in May.
3 years.
Started working full-time here 4 years ago.
A little over a year and a half.
I've been working for Onex for 8 years.
I just passed 2 years, and hopefully many more.
Thank you, Tim. I'd like to note that that video was recorded just 2 weeks before a worldwide pandemic broke out. And we do, you notice that a lot of the people said that they'd only been with us for a couple of years, and there's a reason for that. But we also have people that have been with us for 30 and 35 years as well. They just didn't happen to be on site the day that the video was filmed. You'll also notice that for a manufacturer, we're pretty young in age. We're about 39 is our average age here, so we're proud of that too. But this was not an easy journey for us to become second generation family owners. When Drew and I started this journey, it was 2013, and we were faced with a business turnaround. We had a leader that had controlled from a command and control style leadership, and he had siloed everybody. A lot of the employees had a not my job attitude, and the finances were just in a disarray. So first things first, we installed a brand new accounting system and started to figure out where we had inefficiencies in our finances and where we could make quick adjustments. I also knew as a new leader that I didn't know everything. I had no idea how we were doing the processes. And so I went straight to the people that were on the floor and right in the front lines. And I asked, what do you find that's most frustrating? And what takes up most of your time? And that's how we started flushing out the inefficiencies in the company. That's how we started the conversation. That's how we started building trust and rapport again and getting back to that family-centric values that we had once had. I call that a much more democratic leadership style. Also, this transition took us 4 years. It was 2018 when Drew and I purchased the business from his father, becoming second generation family owners. Next slide, Tim. So while second generation family owners are usually about 30% effective, the third generation is only 13% effective. And so these are our two little ones that have grown up since then. But we were concerned, what do we do since the statistics are kind of against us in this third generation? And you can ask, like, why is that? Why do only 13% of these third generations succeed? And sometimes it's because children feel obligated to take over the business from the parents. And sometimes it's because there's too many family members on the payroll for the business to support. Or sometimes maybe the previous ownership has just stayed at the helm for too long and the company hasn't innovated and changed as it should with the times. After all that we had been through, Drew and I, as a family with his mother and dad, to make that second generation transition, we knew that we wanted to start really early on what our transition might look like. We also knew that those odds were stacked against us for our boys, the third generation of the family. So we wanted to review all the options that were available to us. Next slide, Tim. Thank you. So Drew's father had tried to transition the business to key employees and partners, and obviously had tried to transition the business to us, his family. The problem with this was the buyer usually has to pay with after-tax dollars, and it can cause a cash flow issue for the company if you're trying to do that with distributions from the company. The other issue is a seller may need to have a seller's note so that the new owners can take over the company. But this can be risky to them because now they're not managing the company, and if the new ownership isn't successful, then the sellers don't get all the money that they should. The other option is to sell the company to an outside purchaser. The owner gets to exit right away if they so choose. They get the money. The problem herein lies is that the leadership team may or may not stay intact. The company may or may not stay in the local community, and the culture of the company won't necessarily be preserved. And then obviously the fourth option is least desirable in that the owner didn't make plans for their transition. And if they become disabled or they pass away suddenly, the business could have to close and liquidate. And that's absolutely devastating for the employees as well as the community in which the business exists. Next slide. So no matter which choice you choose, you need to plan and prepare the company for sale. You've got to organize the books. You need to get a business valuation. You need to improve your financial performance, streamline those operations, just really analyze and address any weaknesses. You also need to have a team of advisors. As business owners, we're busy running businesses. We couldn't possibly know everything that there is to know about a business transition. So you need a CPA, a corporate attorney, a business evaluator, an estate planner, and a wealth manager, just to name a few. So your business transition plan it's a roadmap for executing and taking care of all the details that there are in transitioning a business. And I will tell you that transitioning a business is both personally and emotionally very challenging. I've been on the buyer side and I've been on the seller side, and neither one were easy. But I want you to think about this. If you start early and you plan and you do the hard work that it takes, the transition can go smoothly and you can have control over the process. Next slide, Tim. So you're probably wondering which option we chose. We chose a modified version of option number 1. We see our Onex employees as family members, and we enjoy working within the culture that we have created. We're proud to be known for our experienced, creative, hardworking people who are committed to innovative solutions and treat each other and our clients as family. And as Peter Drucker from the Ford Motor Company once said, culture eats strategy for breakfast. This family focus and the culture as created has made Onex both strong and successful. This unique and powerful engine for success actually changed the playing field for us and helped us reimagine what family owned really meant. Even though Drew and I sold 100% of our shares to the ESOP, we continue our leadership roles at Onex. And if our boys want to work in the family business one day, they can absolutely choose to do so. But our employees are no longer dependent upon our immediate family for their welfare and well-being. You see, this company is going to remain in Erie for generations to come. The tax advantages helped us finance the ESOP, and we were so excited to learn that our employees would have 2.5 times more in their retirement accounts than just the traditional 401k match. So when Drew and I reviewed all of our options, an ESOP was a no-brainer for us.
Fantastic. Thank you so very much for that, Ashleigh, for sharing that story. Really appreciated hearing it. We're going to take a brief moment here to talk a little bit about some of the questions that may have come in from our attendees. We, again, encourage you very emphatically to ask any questions that you may have using the Q&A function. You can, of course, always use the chat, but the Q&A function is easier for us to deal with. And just to also give you an idea, Ashleigh brings a very vast wealth of knowledge with her beyond just the ESOP. She sits on several boards, including is the chair of the board of the Northwest Industrial Resource Center, which is a manufacturing extension partnership. And she has also recently written a book, too modest to say it herself, so I'll say it for her gladly, called Leading with Grit and Grace, A Journey of Organizational Culture Change. So definitely lean on the expertise that is on this webinar while we are here. We warmly encourage it. I will go ahead and begin asking some of these questions. Some of these will be for Ashleigh, I'm sure. Some of these will be for you, Lauren. So I'll just go through them in the order I see them now. Our very first one is, can I sell additional ownership to a management team? So I'll give that one to you, Lauren.
Great. You can't, no. The ESOP, the way the stock is allocated among employees in an ESOP company is rule-based. So what most companies, about 85% of companies do, is allocate shares in proportion to compensation. So the management team would get a greater number of shares in proportion to their compensation, but you can't pick out individuals and give them a individual specific amount of shares inside the ESOP. However, what you can do, and what a number of our company members do, is create another system alongside the ESOP. That might be a cash bonus program. You probably already have that. But you can also create something like a stock appreciation rights plan or a phantom stock plan. If your company does want to give additional compensation to an executive team, a management team, you can do that outside the ESOP by using a well-crafted equity stock-based compensation plan specifically for your executives.
All right, thank you for that, Lauren. The next question we have is going to be not entirely easy to answer because there's going to be a variety of answers, but it's, why don't business owners know about the ESOP option? So I'll actually give that one to you first, Lauren, but then I might ask you, Ashleigh, if you can provide a little bit of color of the sort of difficulties you encountered in learning about this. So go ahead, Lauren.
Yeah, I'd love to hear your answer to this, Ashleigh. My sense is that there are a few reasons. I think a lot of people are aware of ESOPs, but may have misconceptions about them. What we found is that a lot of people get their knowledge about their ESOPs from their service providers, and a lot of service providers are not experts in ESOPs, so they tend to steer people toward other things. If ESOPs are not simple, you need a good team of people with ESOP-specific expertise. And if you talk to someone who doesn't have that or doesn't have that expertise in his or her firm, they may try to steer you in another direction. Another smaller reason, I'd say, is that there have been a few very public companies, generally publicly traded, enormous companies like United Airlines, that had an ESOP and where things didn't turn out very well. What we've seen is that in private companies, the companies that maybe don't make headlines outside their local newspapers, ESOPs work really well, and that's clearly what the data says. But a few spectacular examples where things didn't go well, it has done a lot to poison the well.
Awesome, thanks for that, Lauren. Ashleigh, if you may have some insights there as well.
Yeah, so I can definitely share that when Drew and I were looking how to transition his father's business, an ESOP was not really brought to our attention at all. And I think Lauren hit it right on the head. Like, if the service providers don't understand how an ESOP works, they do try to steer you in different directions. So in my opinion, the ESOP world is kind of a really small, very specialized world. And I wouldn't just lean on maybe your normal attorney or CPA. I would look to somebody that really specializes in ESOP to understand and learn more about this option.
Awesome. Thank you for that, Ashleigh. There's definitely, of course, a bunch of other reasons why it might be the case, why they lack the visibility. But those are some of the big ones that we just hit on. So you got to be able to find people who can speak confidently to it, I think, is such a big factor in it. Let's see. Next very good question we have here. Does your business need to be at a certain level of income and or staff size to consider this strategy? So Lauren, again, direct that to you.
Sure. And the short answer is yes. There is some transaction cost. It does take some money to set up an ESOP in the initial year. It takes some more money to do the valuations and administer the plan from year to year. So very small companies, it doesn't usually make sense to put an ESOP in place. What the minimum size is, there's no hard rule there. Onex is certainly on the smaller side for companies that have done ESOPs. There are the largest privately held ESOP company is Publix Supermarkets with over 150,000 participants, but the effective range is most commonly somewhere around 75 to say 300 employees is I'd say the most common size for an ESOP. There are some other things that might make a company a better or worse candidate. If a company has wild swings in profitability and some years of losses, that might make it more difficult. If the company has a large portion of its workforce that is very high turnover, that might make it more difficult. If a company has a very high equity value relative to its payroll, that can make it more challenging. We've got some of these listed in the booklet that Jordan just mentioned in the chat.
And then Ashleigh, was the size of your business at all a concern as you were making the transition to an ESOP?
So that was definitely part of the question. So when we were going through and thinking about the options that were available to us, we did not think an ESOP was available as an option. But Kevin McPhillips from the Pennsylvania Center of Employee Ownership had come to present at the Northwest IRC succession planning event. And I happened to be there because I was a panelist and I'd just gone through a transition in the family ownership side. And so I just snuck over and sat down with him at lunch and said, hey, like, how big would we have to be? Like, what does this look like? And so I kind of explained the business to him, and he said very much like Lauren had said, you know, kind of getting that EBITDA in line. We do have 32 plan participants. So to Lauren's point, we are a smaller company than you would normally see, but it did work out. So there definitely are some exceptions to the rule.
Great, fantastic. There's a question that's coming in a few different channels now. I'll throw this one to you, Lauren, to sort of lay out, which is how does an owner get paid if the employees don't purchase shares?
Okay, good. Yeah, thank you. That's a good one. So the company makes contributions to the ESOP. The ESOP uses those contributions to buy shares from the current owner. That's the vastly oversimplified version. There are a few different ways it can happen. The company may take a loan, and the ESOP may take a mirror loan and use that to buy a big chunk of shares from the owner all at once. In that case, the company contributions from year to year go to pay back that loan. So it can stretch over a number of years. It's possible to do, as we'll talk about in a bit, it's possible to do an ESOP transaction that doesn't involve a loan. So the company decides how much it can afford to contribute to the ESOP in any given year. The ESOP uses that contribution to buy a smaller tranche of shares from the owner. So it could be that the ESOP would buy 3% of shares one year, 7% another year, none another year. And that can go on for a while.
And then there's a related question here, which is how big a risk to the company, how big a risk is it to the company for a leveraged purchase where the company or ESOP borrows funds to pay the price? And that I'll throw to you as well, Lauren.
We'll have you answer that as well, Ashleigh. But so generally, it's not that big a risk. I mean, certainly it is debt. Any debt adds a burden to the company. But the data on how ESOP companies perform shows that risk is very small compared to other similar loans. And the fact that ESOP companies in general outperform non-ESOP companies also shows that taking on that debt doesn't put a dent in their ability to continue operating successfully.
Fantastic. There's a few questions I'm going to collapse into one because they're sort of about where you find ESOPs, right? So I'll read the questions and then we can talk a little bit about where you might find them. So does an ESOP make sense for professional firms, for example, architectural or engineering firms? And do ESOPs work for service or consulting businesses? So my short answer is yes. There's no type of business that is inherently necessarily better or worse for an ESOP. It's about, like we said, some of the size of the business and the sort of the proclivities of the selling owner and of the culture, right? Those things matter much more than what type of business you are. So we have We have ESOPs in architecture and engineering. Actually, those are some of the biggest industries that you find ESOPs in. Of course, manufacturing, which we have represented here by Ashleigh. You see it a lot in the sort of the retail and grocery space. There's no limit to what type of business necessarily, or what type of industry you'll find ESOPs in. I don't know if you want to add any more to that, Lauren, but both the long and short answer is any type of business can be owned for the benefit of its employees. So, and then there's a few more questions. There's actually quite a few more questions in here. So forgive me if we don't get to your question. I'm hoping we can hit the vast majority of them. But if we don't, you will have an opportunity to have some of our contact information so you can reach out afterwards, as well as the contact information of our sponsors, all of whom are going to be ESOP experts as well. So the next question I will pose is, ESOP plans can't be discriminatory, right? It covers all employees regardless of their level, or it won't cover anyone. So again, Lauren, I'll leave that for you.
Yeah, that's correct. There are a few things that that you can do, that reasons that you wouldn't cover all employees. For example, if you have a workforce which is partly represented by a collective bargaining contract, then the ESOP, as all other benefits, would be the subject of collective bargaining. So some companies that have union employees include those union employees in the ESOP. In other cases, they have an alternative plan for the union employees. That's one possibility. There are a few people who may be excluded from the ESOP. There's more legal complication here, but in some transactions, the person who sold the shares and his or her immediate family cannot participate in the ESOP. But basically, the thrust of that question is right. ESOPs are non-discriminatory. They've got a lot of rules to make sure that they don't excessively benefit highly compensated employees, for example, and they've got a lot of rules to make sure that people are all fairly treated by the ESOP.
Fantastic. There are, sorry, I'm trying to navigate these questions in a way that builds like a sort of a thread, so there's continuity to it to a certain extent. There are quite a few questions that speak to the sort of the culture and the transition that I'm gonna direct towards you, Ashleigh. So the first one is, where are you on the development of a board of directors? And did your thoughts on the composition of your board of directors evolve as you went down the ESOP road?
So we do have a board of directors. My husband and I sit on the board of directors, as well as one independent board member. And our independent board member is also in manufacturing, similar age to us, just bought a business a few years ago from, I guess it was the president sold the business outright to him who had worked in the business. So we're of similar mindset and similar industries. So that's the current composition of our board.
Fantastic. And we at the Nceo, we have quite a few resources on best practices when it comes to ESOP boards, quite a few publications that deal with that. One publication that I refer to for all things ESOP is called Sustainable ESOPs, and there's some great chapters in there about best practices for the long-term sustainability of your company when it comes to your board of directors. Another question for Ashleigh is, how do you handle and excite highly compensated employees in a new ESOP? I think that could actually be extended to sort of all levels. But so for highly compensated, that's one. And then also, how do you get frontline employees excited about it as well? So what are the ways in which you sort of communicated and built the excitement around the ESOP?
So I don't know that there was a big difference for us between highly compensated and everybody else. But what I did do was, prior to the pandemic, on March 9th, I had Kevin McPhillips come up and I had him speak to the leadership team. I told them what we were up to, but I had Kevin come up to answer any questions that they had as far as the ESOP transition would go. And the reason I did that really early on is because we're a pretty small company and I was going to need some people's help, to make it through the transition. And I just didn't want rumors flying that we were selling the business. It also gave the leadership team an opportunity to be on board and be advocates for me as we told the rest of the organization about the ESOP. And so they kind of had they were more familiar with it. They were able to speak to it. They were able to say, no, this isn't a joke, as we launched it into the rest of the organization. And then from a cultural standpoint, I think we had done a really good job already being kind of in that trustworthy, family-centric culture ahead of the ESOP transition. I do think culture is a huge part of being an ESOP. So when we told everybody, when we announced that we had become an ESOP, it was just tears. They couldn't believe it. It wasn't that they thought that we were lying to them or there was anything weird going on in the background. I will say, since we've told everybody, one employee said that he now proactively looks for ways to improve the entire business. And I think that's the best way that you could put it at all. It wasn't that he was bad before, but he might have been a little more reactive in things, where now he's proactively searching out ways to improve.
That's fantastic. That echoes a story I've heard and then oft repeated, because I think it also illustrates that sort of mental shift. And it actually comes from another Pennsylvania company, our friends at New Age. Ken Baker often tells a story about someone who was using the forklift and sort of laying a patch. That is, I guess, to burn a little bit of rubber, let's say. And he came up to this employee and said, "Why are you doing that to your forklift? Now employee owners, this is an asset that you control." And then also points to a coworker of his, and also you're doing this to his forklift. And so it's this idea of like everything you do now has this impact on your own bottom line and on the bottom line of the company that you hold a stake in. And it really does create that sort of that click that shifts people's mindsets. There's a really great question that came in, I think is fantastic, really. And I'm going to point it to you first, Ashleigh, and then you as well, Lauren. It says, "We are considering starting an ESOP in 3 to 4 years. Are there things we should be doing now to prepare for that transition?"
I would say yes. There's a lot of things, 27 pages of things that you should be doing now. It's called the due diligence list. So when you start this transaction, it's just like any other transaction that you'd be selling the company. It doesn't matter whether you're selling third party, in-house, or to an ESOP, you have a due diligence list, and it goes in, all these items go into a data room. So definitely I would, go ahead and talk with an advisor, understand what that list looks like, and start preparing for it. The other thing I would say is, as with any sale, really ferret out your weaknesses and start to work on those and solve those ahead of time.
Fantastic. Thank you. Anything that you would add there, Lauren?
Yeah, thanks. I completely agree with Ashleigh. The 27 pages made me laugh. A couple of things you might think about that we've seen companies be glad they did before putting an ESOP in place. One is to give people a little bit of background about business literacy, because if the better they understand how businesses work and how your business works, they don't need to understand everything that goes into it. You don't need to get deep into the nooks and crannies of your balance sheet or income statement, but the better they understand the basic concepts and some of the moving parts about how the business works, the more ready they'll be to understand and appreciate being an owner when the time comes. A second thing I'd recommend is something that Ashleigh already mentioned, which is having an independent director. It can be nice to have that in place before you do an ESOP transaction. About 75% of our member companies have at least one independent director on their board. And for those of you who are interested, we'll also have our corporate governance survey going out in May this year. I encourage you to participate in that and you'll get the results. And then the last thing I do is to take another, to lean on you again, Ashleigh, and say, I think another great thing to do is talk to companies that are a few years ahead of you and look at some of the specific things they've done to get ready for the ESOP. It's so much fun to take a tour of an ESOP company. Back when, looking forward to the future when we can actually do that.
Right, that's right. safely, that is to say. There's a handful more questions I want to get to, and then we'll sort of continue out the presentation as it is. And let's see, real quick. So there's a question, where'd it go? So even if you sell 100% of the shares, the former owners direct the company from the board positions. And I'll start that answer with no, in short. The real answer is that ESOPs are extraordinarily flexible. So a selling owner can start by selling just 10% of the shares, can start by selling just 15% of the shares and stay on in whatever role they are, whether it's president, CEO, what have you. They can also sell more than 50% of the shares, selling a controlling stake to the ESOP, but still stay on in whatever role they are. That type of stuff is ironed out in the process, in the sort of, as you're setting up the ESOP, the roles of the selling owners as they currently are and how they'll develop is something that will be ironed out. And it's very, very common for selling owners to sit on the board for sure, but that's also not always the case, nor is it required. There's so many good questions. I'll do one more. It'll be to Lauren because you alluded to these, but there are some questions in the chat about what are the tax benefits exactly of selling to an ESOP. And I think there's probably two primary ones you'll point to. So go ahead, Lauren.
That's right. So the two primary ones, one applies to C corporations, and that's where when someone sells shares to an ESOP in a C corporation, they can defer the capital gains tax on that sale. You need to meet some requirements. The ESOP needs to own 30% of the shares after the transaction, but that's basically how it works. You defer the capital gains until you sell the property that you buy with the proceeds from the sale. The second main tax advantage is for S corporations, which is that in an S corporation, tax on profits is paid by the shareholders, not by the company itself. If the ESOP is the only shareholder and the ESOP is a non-tax-paying entity, then the company doesn't pay federal corporate income taxes and doesn't pay state corporate income taxes in most states. There are other tax benefits, but those are the largest ones.
Fantastic. So there's a bunch of other questions I know in there about sort of how long it takes, how much it costs. And again, it's going to vary very widely, depending on the plans of the selling owner, depending on who you go with as far as a service provider, depending on how big your team might be. There's how big your company might be. All of these things are going to factor in to how the actual process will play out. But that also means that there are options available to you, that you don't have to do anything one way. If you're starting to go through this process and you wish it would go a different way, you can absolutely begin to shift that, right? There are so many great questions. Again, you'll be provided contact info where you can get these questions answered. All of them have answers. We just don't necessarily have the time to get to them at this moment. Right now, I am going to launch a quick poll for everybody. When you launch a poll, I'm doing it right now. When you launch a poll in Zoom, it might pop up in a different window that is hidden. So if you don't see it right now, it might be behind the window that has me speaking, so you might have to look for it. The question is, would you like to be connected with any of the following groups? So there's ESOP companies in your industry or area, legal services, M&A or transaction experts, ESOP design services, valuation advisors, or all of the above. So go ahead and fill that out. We will use said information to make sure that you are connected with the appropriate people after this presentation. I will leave this up on your screens for 20, 30 more seconds at least. While it's up, I'll actually ask a few more questions. I think that's a decent use of this time. One question we have up here is, who guarantees the bank loan which funds the ESOP payment to owners? So I'll give that one to you, Lauren.
Sure. So it's possible that no one does if you have a strong relationship with your bank and it's a small loan. More often, the selling owner or owners do guarantee the loan, at least for a time. Another possibility is that the ESOP can be financed in whole or in part with a seller note, in which case guaranteeing the loan isn't really relevant.
Fantastic. And I'll leave it up just briefly more. One other I think is important to cover, which is, can you explain more about how employees benefit from ownership in the trust? So again, I'll throw that one to you, Lauren.
Okay, sure. So the employees benefit as they benefit from other retirement plans. So legally speaking, that's the benefit. They get assets in an account which they can then use to fund their retirement. It's a retirement benefit. In practice, I think people benefit in lots of other ways. If you look at it from a non-lawyer perspective, I think the video that you showed, Ashleigh, just shows people who are simply getting more out of their work lives and feel more satisfaction than others would.
Very good. All right. I am going to resume sharing my screen, and we will finish out the conversation that way. Give me just a moment. There we are. You all should again be seeing the presentation. And with that, I will turn it back over to you, Lauren.
Great. I'll cover these last slides briskly. I just wanted to show you some of the market research we've done, and I think it fits very nicely with the way Ashleigh talked about the Onex experience and how she and Drew made this decision. These are what people say they care about, what drew them to an ESOP as a strategy for leaving their businesses. And we so often hear about people who maybe were entertaining a purchase by private equity or some other outsider. And some of these things, what's going to happen to my management team, came to their mind and sort of derailed that process. So let me move to some of the other pieces, the next slide to cover here. I just want to give you a very quick overview of, if you decide that an ESOP might be a good fit for your company, here's what the process would look like from here. After you've gotten yourself educated, the next step is usually to put together a formal feasibility study. That you'd generally hire an outside firm to do that, to come up with what transaction structures might make sense for you, what the numbers might look like, a rough value. Once you've done that, and if everything's looking feasible, then you'd hire a team of advisors. As Ashleigh mentioned, it's essential to get a good team. We have a service provider directory that can help connect you to people who have experience with ESOPs. You'll want to develop a transaction structure, such as whether you have a loan or whether you make a non-leveraged ESOP. You'll need to then establish the trust and appoint someone or some people or an institution to be the trustee. The trustee will hire the independent appraiser to determine the fair market value for the transaction. Then you'll negotiate the terms and conditions. This is actually a negotiation. If you sell 100% of your business, you are selling 100% of your business. And so there will be a negotiation. Then you close the transaction, communicate everything to the employee owners, and then you're in the fine position that Onex is in, and you're employee owned. I'll just briefly mention that this decision, whether you borrow money to finance the ESOP transaction, has an enormous impact on how that feasibility study will come together and how it will work out. Leveraged transactions make it possible to go from 0% ESOP to 100% ESOP in a single transaction. You'll pay that loan back over time. And a non-leveraged ESOP transaction will pay the owner in tranches that can vary based on how much the company can afford in any given year and the priorities of the owner. In that case, the owner would be paid each year over time. And you can combine these two as well. Non-leveraged transactions tend to be much quicker, tend to be much simpler and less expensive. One of our local ESOP companies here in Oakland, Zachary's Pizza, started with a non-leveraged transaction where they sold a bit each year as they saw how things were going. When they got to 43%, they decided that they were very satisfied with how the ESOP was going, and they sold the remaining 57% of the shares, dyslexic, in a single transaction to get to 100%. All right. And then the last thing I want to mention is one of the great things about an ESOP, which is impossible to quantify or put in a financial statement or a term sheet, is that there is a community, and this is a supportive community. The Nceo is thrilled to be part of it and to help connect you to good resources and people to learn from. We can help connect you with existing ESOPs who are in your field or your area if you'd like to talk to a peer. Our service provider directory can help make sure you talk to some of the service providers that really do have experience with ESOPs. Jordan and Tim and Ashleigh all mentioned the Pennsylvania Center for Employee Ownership. They're a great organization. There are a lot of other organizations in this space, and we're blessed with a lot of expertise and a lot of generosity. People share very openly about how the ESOP has worked for them. All right, Tim, I know you've got some closing remarks, so let me turn this back over to you.
Fantastic. Thank you, Lauren. Let me start my video again so you can see me while I talk. Thank you so very much, everyone, for being here. Just want to run through a few extra resources that will be available to you in short order that you can have access to should you like them. As a part of your registration here, one thing we've done is gone ahead and made you a recipient of the Esop Essentials. So Esop Essentials is a collection of information which will be distributed to you in a PDF form, which will take you through all the basics of what it is to be an ESOP. A lot of the questions that you were asking that we didn't get to will be addressed in that material. Also, as a member of the or as a part rather of Esop Essentials, you will be given access to, for 6 months, Nceo member resources. So that includes upcoming webinars, our virtual learning series, which we call Employee Ownership Compass. It's a variety of different types of learning experiences, some of them more conversation-based, some of them more presentation-focused, all of them around different topics, and all of them designed to get you the best and most up-to-date information on ESOPs and being employee-owned. Also, we have our upcoming Employee Ownership Conference, all digital, all online, in April. There are pre-conferences on April 16th, and the main sessions are on April 20th and 21st, excuse me. Our conference covers a wide range of topics, and it's a great place also to meet the employee-owned companies that we were talking about today. So, you know, Ashleigh, of course, will be there. We'll be delighted to have her present there as well. But if you're looking to learn directly from employee-owned companies, our Employee Ownership Conference is the best place to do it. We encourage you to attend. And as always, we are here as resources for you. So if for any reason you have any other questions or thoughts or comments, by all means, we encourage you to reach out to us. And last but not least, I would be remiss if I didn't once more thank our sponsors, to whom we are very, very grateful for their support. So once more, an enormous thank you to Atlas Legal Services, Butcher Joseph, Menke, South Park Advisors, and Butterfield Schechter LLP. Again, with the generosity of our sponsors, we're able to put on such content like this, and these people are experts as well, so we will be able to connect you with them should you so desire, as indicated in the poll. And that concludes our presentation. So thank you very much for joining, and be on the lookout for any follow-up from us. Thank you very much also to Lauren and to Ashleigh for sharing their time and their expertise.
Awesome. Thank you, Tim. Thank you, Jordan, behind the scenes, for making this happen. And Ashleigh, thank you so much.
My pleasure.
Awesome. Thank you.